Einstein said compounding interest is the eight one-third of the world. Who understands it earns it, who doesn't pays it. And so
Hmm.
you can clip a 2x return in 5 years through quarterly reinvestments.
All right, everyone, and welcome back to the Real Money Talk. This time, you guys know my favorite time of the month is when we get to do our monthly member spotlight. So, this is the chance where we get to talk to real people making real money so you can too. And this month, I'm very excited to introduce Patrick Grimes. He is founder and CEO of Passive Investing Mastery. So he's got an entire diversified investment portfolio across energy, litigation, finance. We're going to get into the details of that because we've got some great visuals with you. And his background is so extensive across multiple industries, multiple accreditations. And so what I really appreciate about Patrick is his work on focusing into recession-aware investing and giving his investors access to real alternative assets that are not tied directly to the stock market or what most people are familiar with in the real estate world. So today he's going to walk us through some specific strategies that he and his firm offer, including the litigation finance and medical receivables. Again, we'll let him get into the details of that. But this is going to be a great opportunity to look at some diversification and non-correlated returns for investors. So, Patrick, welcome. I'm so glad that you're here.
Eric, I'm glad to be on here, and it's been good getting to know you. I think we first chatted when we were both on was it a tax strategy panel in Seattle?
It was in
Uh,
Seattle. Yeah, it was
yeah,
at the
maybe
MFIN
that.
conference. We were on, it was the tax strategy panel. Yes, very good memory. I
Uh,
remember that day very clearly. It was a good time.
and since then, I've had you on my mastery series, and now you've reeled me in, and I'm a card-carrying member.
Yeah,
Obviously,
he is
kind of rogue
officially an infinite
game.
banking believer. He has become the
Yeah.
bank himself. Yes.
Mhm.
I love it. Well, yeah, and I think with your particular offering, and we were just talking about this, um, your particular offering, one of the things that I'm excited about, we on the Real Money Talk, we're getting into, like I said, real people making real money and how you can too. Within this particular sector, in this particular chapter, so many people I talk to are business owners and or real estate investors, and those are excellent areas to be in. But what I like about this particular conversation is that we're kind of actually going into the alternative of alternative assets and looking at some really truly diversified investment options that you provide to help people really get into that recession resistant area to offset some of the other fluctuations they might be seeing, especially right now. So before we get into that, I want to kind of pull back and say, okay, let's talk about you and your background. And I'd love for our audience to hear a little bit about your journey and how you came from mechanical engineering into building a diversified investment plan.
Sure. And I think what I've done is share that the visual aid you said you liked.
Yes, I
Can you see?
love it. I'm all about
Okay,
the
great.
pictures.
Yeah. So, yeah, Patrick Grimes, I think like many of your listeners, if they're business owners or, high paid professionals, that's what I was. I was a mechanical engineer slaving away and doing machine design, automation, and robotics. I have a master's in engineering, an MBA. And I was doing some pretty cool stuff. In fact, that picture there up on the left were robotic assembly cells. The one behind my head was a Lockheed satellite solar cell assembly. The one above my forehead was actually Tesla's robotic rotor assembly that puts the copper in the metal stack for
Oh,
their
wow.
rotating part of their motor. And right next to my chin was a robotic assembly of a flu test kit with spider robots doing over 100 a minute, and that
Oh,
got
gosh.
converted later to a COVID test kit assembly machine. So all kinds of weird stuff. And in the medical space, I was also doing heart valves and catheters, but I loved it. And I'm still a huge geek. You know that, right? And so I may not be doing
We are in
engineering.
nerd world. That's okay. You're welcome here.
Yeah. And then, but and when I was, if was not an engineer out of college, just thought I ruled the world, I decided, man, I got to figure out how to invest because I'm getting bonuses. And I wasn't raised in a family. My whole families are educators. My dad's got three doctorates or had three doctorates, but that doesn't mean we had money growing up, right? So it meant, we were we were taught to learn. But I had some bonuses. I was like, well, let me invest. So I actually got some advice from the founder of the company I was working for, and he said, hey, I make all my money in high tech, and I spend it all in alternatives. I buy real estate. My only regret was not buying more sooner. So I dove in head first. I didn't really know what I was doing. I just knew I was a talented engineer and figured it out. I invested big into a pre-development. Unfortunately, this was before 2009 and 10,
Oh,
and when that happened, took me down hard. I was personally guaranteed. So my
oh,
yeah, my
oh.
first leap ended into a giant pit of despair, and it took me years to recover from that. But they say fail early,
Yeah.
right? Fail quickly, and that's what I did. So the rest of my career was, I was still a very talented engineer and battered and bruised on my ego, and but um, I after going to graduate school and actually traveled the world a couple times, couple gap years in there to recenter. And hiked the base camp of Everest, whitewater after the Grand Canyon, went through the Middle East and Asia,
Oh,
did a bunch of
wow.
really, really fun things. But found myself back, with bonuses, figured out how to invest in resilient alternative investments for cash flow.
Mm.
Of course, real estate is where people start. So I was actually buying existing construction, single family, in what I calculated to be the most resilient market at the time, based on how it performed in 2009 and 10 in Houston. And so I started
Mm.
moonlighting single family real estate, which was working great. It just took over my life. And then when I met my soon-to-be wife, whom you met, I think she was with us there in Seattle, and she was
Yes.
watching us on the panel. And now we have a 3-year-old. Now we're out of Hawaii. But when I met her, I actually stopped doing single family, told her I had to take a break. Then I ventured into getting married here in California and then Beijing. And then I realized I needed something that would scale. So I
Mhm.
switched from being a W-2 to a contractor in engineering. And I traded from just the DIY moonlighting to partnering with others in other markets to do larger apartments. And so then we traded that up to a situation where I realized, man, we're going to talk about allocation strategies in a minute, but I found myself over allocated in real estate again. And
Yeah.
that's when I found a passive investing mastery to me more true, to not just be the guy that has real estate deals, but be the guy that can educate on alternative strategies which build true financial security. Riding high tech and riding real estate waves, that didn't work for a lot of people.
Hmm.
And that's not how the hedge funds, the sovereign funds, the private equity groups, family offices create and sustain wealth over the generations. And so um, our platform works to make that more accessible, the true strategies for true financial security to accredited investors.
And I love that because there's two sides of this that I really appreciate. And the first one is, well, there's a couple. One, you had the ability to get into the market without so many people do paralysis by analysis, especially engineers, right? I think we've had this conversation.
Oh
Engineers
yeah.
are, they like to pick things apart and really dive into it. But you did take that leap of faith into getting into real estate. It obviously happened to not be during the best time. But one, you took the leap. So that's incredibly powerful. Two, you did get burned. You got burned bad. And so for
Hmm.
you to crawl out of that hole and say, hey, that hurt, but that doesn't mean that I can't do this better. I think that speaks to you to be able to say, hey, like you said, if you're going to fail, fail early. And you did that. And then you just got right back on the horse and figured out, how can I do this again, but do it better? And that's incredibly powerful because there's so many people who have either one, been through that in 2008, 2009, and or are going through it right now, right? We've seen a lot of people on the real estate side have some issues over the last few years with these massive interest rate swings. So just because it failed once doesn't mean that you can't get back into the game and do it better the next time. So I mean, you're a testament to that, and that's an incredibly powerful story. So I appreciate that so much.
Yeah, when I wrote, I contributed to the first book I contributed to was Persistence, Pivots, and Game Changers, and I was referred into that book. I think because I had to have persistence to stay in the game.
Oh,
So times
absolutely.
in the high tech space alone, man, that was a brutal space, right? As you went through so many, ups and downs, because R&D spending is the first thing to be cut,
Mm,
through times. But just like in any industry, you can be in high tech, but you can be also in healthcare and defense, which fared well. Just like in investments and alternative investments, you can ride the cycles of real estate, or you could also be in energy. You could be in medical, you can be in legal, and you can fare well because the net portfolio will help you stay alive, right? In
yeah.
those cyclic times. Um, so like our company now is based on education and investments,
Mm,
right? And when I was an engineer, I wished that somebody was coming to me and saying, "Hey, here's the 50 alternative ways you can invest. Not here's the 50 stocks, cryptocurrencies, and startups," right?
hmm.
Nobody's doing that. And there still isn't anybody today. And people are still, all they know about is their retirement account custodian that's keeping them trapped into equities, right? Index funds. So it's truly our goal there is to just blue ocean approach, and I used to trade the baseball cards of alternative investing strategies with just a few dudes, like 5 or 6 dudes. And we were the only people that knew about it. Did you hear about this? You hear about that? And nobody really, we didn't know anybody that even cared to know. It was just kind of like we were just in our small world. And so I
Hmm.
started sharing my hand and then sharing the whole deck. And that's what we've been over 60 different alternative investing mastery series
Wow.
sessions. I'll show you what that looks like in a second, but and you were on one of them, and
Yeah.
it's because it's not only here's asset classes, but here's advanced strategies on tax efficiency and asset protection and portfolio construction and all these things, infinity banking, right? Things that help you do it efficiently and safely,
Yeah.
asset protection, right? And so that's what that education arm is about. Anybody that's interested can jump in there. I write for Forbes. I've got a bunch of books and contributed towards, and we have a biweekly Wealth Accelerator series that comes out, and we have our Mastery Series sessions where you can jump in there and just immediately start learning about stuff. We also sponsor investments, and that's where I'm part of the solution. I'm not
Hmm.
just saying go do, but uh, Passive Investing Mastery was really meant to be a version of what I believe to be the way you build security from somebody who's had insecurity for a lot of his life while out there doing things quote
Yeah.
right? Buying into real estate and then
Yeah.
investing and then being in a high tech job and the cyclic ways, that
Yeah.
those things that
You
are
did
the
all the
right.
things right.
Yeah. And so how do you actually get there? Well, you build recession resilient, non-correlated alternative allocations into multiple industries. And that not only gets you to not just independence in one industry, but true security through an
Yeah.
allocation strategy. And we're hoping to get you to a point where you can contribute towards the causes you care about most. I mean, my wife and I are at time freedom and location freedom now. We are in Honolulu, and we have our 3-year-old who runs back and forth throughout the day here in the living room. And I get to spend, more time than I did. Um, like we really focus on when we launch an investment, we focus on, hey, what's recession resilient overall, right?
Yeah.
I don't really like the huge cyclic markets. And so what tends to not, most investors are highly indexed in the stock market. So you might as well
Yeah.
start being resilient from broader market volatility. And then what's a personal question for everybody is what's non-correlated? What doesn't rise and fall with everything else in your portfolio today?
Yeah.
Maybe you're all in the stock market and real estate's a good option. Maybe you're way over indexed in real estate and real estate's not the right next move, right? We'll talk about what those look like. And then recently, in the last couple of years, I've been really focused on insulation from AI disruption. And
Oh man,
that,
that's key right there. A lot of people are having that conversation. Well, a lot of people are worried about that, so I'm glad you're having that conversation because that's on the horizon. It's coming.
oh, it's happening now. In
Yeah, it's
fact,
here. You're right.
yeah,
Yeah.
I'm getting calls from engineers that were very talented, successful guys wondering if I still have connections in the space because nobody's hiring. They're actually reducing workforce. And we're talking very talented and experienced white collar guys making a couple $100,000 a year or more are now out on the streets looking for work.
Wow. Yeah. So it's not just the blue collar factory workers, right? Being, I know a lot of people think of low skill, low labor, and it's not. It's like you said, the white collar educated engineers, for example. Wow.
Yeah, if
And
you look at Facebook's most recent and Anthropic's most recent publications, it's actually in those blue collar jobs with more touch, hands-on work that have more resilience in
mm,
this wave, which is extraordinary, right? Because we flipped the script, right? Robots were taking away the blue collar jobs, and now the software engineers with AI are taking away the white collar jobs.
oh, how the pendulum swings, right? That's yeah.
Yeah.
Wow, the tables have really turned.
And this is
Um,
a little out of order, but this is, go ahead.
Perfect. No, I was actually going to bring this back up is that what you guys are offering, I think, is incredibly powerful because it's the education. So this alternative investing series, you have those of you that are listening, you have the ability to get in on these calls and hear from a variety of different people with a variety of different backgrounds, and you can learn about the different investment options you have, as well as Patrick and if Patrick and his team have investments that are available. We're going to talk a little bit more about that later, but you have the education and you have the implementation to be able to put this into your portfolio and start getting into some true diversification, not just, oh, I've got some single family, I've got some multifamily, I've got some RV parks. Not that any of those are bad, but they still all fall under the real estate umbrella. These are true diversifications to the real estate or Bitcoin or stocks. This is a completely different asset class. So yeah, this is a great example here.
Yeah, and so we're educating on the odd, weird things like gold mining.
Yeah.
Where does that fit in your portfolio? What about timberland investing or
Mm.
cannabis? Or what about Forex? Or like there's a bunch of you can see on the screen about creative backdoor Roth IRAs and asset protection or estate planning, which was one of the reasons why I got an Infinity Banking. I joined the Infinity Banking crowd because of some of those things, and she wrote articles in Forbes on asset protection, and I like to think I practice what I preach, and so, but yeah, there's a lot of stuff here, and then we educate on this, but then we offer commercial real estate acquisitions, commercial debt. Acquisitions is high growth, especially in a time where you can take advantage of the downturn where values are suppressed and where
Hmm.
there's a lot of blood on the streets and we're purchasing assets at incredible value. And then commercial debt, right? I mean, with banks on the sidelines, small balance commercial, industrial, manufacturing, warehouse, and retail, we're putting incredible high cash flow loans on bridge loans on these properties that are performing. They're not properties that are on the teetering of collapse. We're at 65% loan to value for performing assets that are just struggling to find other lenders because banks are on a liquidity crunch,
Yeah.
right?
This is another version of becoming becoming the bank, right? You are your own bank, but now you can actually, lend out to other commercial people or people who are needing commercial debt. You can start to collect a check just off of their payments. That's amazing.
Yeah, I mean, how to win from a downturn of commercial real estate is, and in an environment with high interest rates, is to buy low assets, buying low, become the owner, or lend high, lend at high rates, right? And that's where we're at today. So, very opportunistic funds. They're both doing great. They're killing it. And to your point, the commercial debt's really, it's called the private credit strategy, right? Because you have a private individual, which can be done through an affinity banking account or any kind of private fund out there financing something, and that's not a bank, right? You're not a bank technically, so you're out there a private individual financing. It's a private credit, and so we lend to commercial real estate operators and take their assets, which are the buildings, as collateral. But then there's other industries you can do that in, like the legal industry or the medical industry, where you can finance attorneys and you can take their assets and put liens against them, just like you do in real estate for attorneys and medical practices.
Wait, you can do that?
That's
Which
so crazy.
obviously is
Who would
huge.
have thought? Like, I had no idea you could even do that. This is a whole new world.
Yeah, and I mean, to me, and forgive the Hawaii term here, but I spearfish the industries that I want to be in, right? because I want to be in those that are very resilient. We talk about that, and now I have a couple picture of our team here, but it shows the partners with experience in all of our affiliate offerings, as well as some of the players in our internal team. I think it's up to like 40 or 50 total
Oh, wow.
that we have working with us, but these are some of the key players that you would see interface or visible like on a regular basis. And if you want to really dig, whenever you're ready, we dig into the heart of what you were wanting me to share, and that's what the heck are these lesser known alternative investments?
Yes. So for those of you who have not already, don't forget this. I'm going to pause for a second and say, make sure that you are subscribing to our Real Money Talk channel. This is an opportunity to hit that button so that one, you're going to get notified of all the different interviews and knowledge nuggets that we're dropping on a regular basis. So you can also get access to people like Patrick and his group, Passive Investing Mastery, to learn more about these alternatives. So if you haven't already, I'm going to pause and say, make sure you subscribe. And yes, Patrick, let's dive into this. I know I am, as well as so many others who are, a lot of our clients and our listeners are real estate investors and business owners, which is excellent, right? There's no good or bad tool. But this is a great opportunity to look at some lesser known alternatives, right? Some things that can actually correlate and complement what people already have in their portfolio. So I'm really excited about this.
Sure. So, we do a disclaimer. I'm not a financial planner, a CPA, or an attorney. I'm actually an engineer. I've had a lot of experience winding my way through alternatives, but this is not tax, legal, or financial advice. And any investment mentioned here is just for educational purposes only. It's not an offer to sell a security. And our investments are only open to accredited investors, and you should reach out to your own team of professionals before making an investment decision. So now that we're past that,
All the fun
it's
stuff's
like
over now.
yeah. So why alternative investments? And I think it's really interesting. Kenneth is one of the better economists, and he said there are really two kinds of forecasters: those who don't know, and those who don't know they don't know, right? And I was there. I've
Yes.
been there a couple times, right? I've been there when the dot-com boom was exploding and we saw that fallout. I was there in 2006 and 7 and 8 when everybody was just saying, buy as much real estate as you can. And then in 9 and 10, it fell out from underneath us, right? I've seen this cycle many times. And it just so happens to be that 11 of the last 11 of the last 14 Fed rate hikes landed in a recession, right?
Wow.
So 11 out of the last 14. So while it always makes sense to be in a place in which your portfolio can ride out any particular market fluctuation, it's especially necessary now. And it's not just that markets can go for a ride and you need to be in what we call recession resilient, but it's also you need to be in what we're going to talk about as non-correlated investments, because not only is it recessions, it's wars. It's wars, physical, it's actual wars, or it's trade wars, right? In addition to interest rates, these are all things that can cause market specific or industry specific strain, which lends itself to spreading it out into allocations. I like to always show this because Morgan Stanley, is kind of like the one financial advising firm out there that is actually touting the truth about the importance of alternatives. And while their numbers are more suppressed than others, they at least have numbers, and it shows that a 25% allocation into alternatives performs 25% better in bear markets and 29% better in rising interest rate environments.
Wow, that's a win-win.
Yeah, and it improves the risk return profile. What does that mean? That means if you look at that graph shown there on the lower left, you can see that it's possible to get a much lower risk and a higher return, right? Because the purely stocks and bonds curve is going to be further along in the risk, and it's going to trail the return. And so it turns out to be that being allocated into non-correlated investments not only reduces your dependence on public markets, reducing your overall portfolio's volatility, but it provides new ways to provide portfolio growth that are higher returning. And this is from Morgan Stanley,
Nice.
right? Not investment advice from me.
Yeah. This is an
And
unbiased third party, right? They probably know what
yeah.
they're talking about.
And then you look at Edward Wolf and you say, well, I mean, how are people allocating? You got middle class, upper income, ultra wealthy. It turns out to be that as investors make their journey through the wealth growth here, they find themselves with about 49% in this alternative bucket. So that's interesting. So what is inside that 49% that's not in stocks, securities, mutual funds, cash in the bank, whatever? Well, here's another graph from Tiger 21 that shows that inside that half, which corroborates about half of the portfolio, we'll call it private equity and real estate, it's a little over half there. But it only shows about half of that half, right, is in real estate. So then where's the 25%? Where do these, and the Tiger 20 is purely the kind of the ultra wealthy, I think it's a 25 million net worth verifiable and up club. And so where's the half of the 49%? Where are they putting it? And it tends to be that they're seeking a couple things. They're seeking this word again, non-correlation, things that don't rise and fall together. So that then when they take their pie and they add a slice, they don't want that to grow and fall with the rest of their portfolio.
Yep.
They want another pillar. They also want something called higher risk-adjusted return. What does that mean? That means you got to invest where everybody's not clamoring for the same investment. And when everybody's clamoring for the same investment product, the price of that product goes up.
Oh yeah.
And it becomes very correlated to the risk. Everything in the stock market, for example, right? Yep. It's very visible, very accessible. And so it's a very efficient market. Inefficient markets that are a little lesser known, a little harder to access, fewer people know how to get involved in them, such as in the medical industry, where there's literally 100 million people that know how to invest in stocks for every one that knows how to invest in the medical industry, right? Yeah. There's 1,000 people doing 1,000 operators out there that you can invest in real estate for every one that you can invest in legal or one that you can invest in medical. So these industries, which are lesser known, they have something called a high risk adjusted return. What does that mean? That means that these people that they're serving, the doctors and the attorneys, they don't have as many places to go. They're happy that you're coming there to solve their need. And what are those needs? We'll talk about it. They're willing to give you a higher return at a lower risk for that investment than you would otherwise get in the real estate industry, because there's 15 other people that will invest in it. Or 15
you're
other
having to compete a lot on the real estate side. So this one, you're like you said, one of a few people. So they're having to pay more because you're this is lesser known and fewer people are available. So they're willing to pay a premium for it. And there is less risk because, like you said, it's the legal industry and it's the medical industry, which, let's be honest, those aren't going anywhere anytime soon. So, yeah, I love it.
And it's how you approach those industries too, because certainly I've automated a lot of my legal contract building, but you can't necessarily automate going into the court system litigating for harm. And that's why we're invested in a specific type of legal funding and litigation to protect or to provide access to justice, or medical practices that are involved in injuries, right? Because it's very unlikely that, the doctors that are sitting there giving care, MRI centers to people that are injured, injuries aren't going to go away.
Right.
General practice doctors, well, that's on the chopping block actually, because a lot of that initial triage can be done through some AI tools. But, it's interesting what those industries are going to do. And so the insulation from AI, you actually have to go deep into the asset class to find the niches that you want to spearfish. So people are like, well, how do you find these lesser known non-correlated investments? And you target industries that have shown low correlation to traditional investments like housing, energy, interest rates, right? And these are education, utilities, healthcare, and legal services. These are actually, there's other ones too, like HVAC repairmen, I believe it or not, plumbers, auto mechanics, right there. These are things that are just needed as you go about life. There's also CPA firms. Oh, but wait, one of my Venn diagrams was insulation from AI disruption, and I'm afraid there is an immense amount of disruption happening in the industry at present. So you find I think it's the big five or the big four accountant firms on the planet are sizing down, laying off, only going for senior people for high review positions because the majority of the work can be done. So traditional non-correlation, traditional recession resilient markets aren't enough without looking at their insulation from AI disruption. And not only the industry overall, but in your specific approach to those industries.
And I love that you guys are going that deep into, right? You're already going into the lesser known alternatives. And then even once you're there, you're still going 3 or 4 layers deep to figure out, right? Like if we're wanting to go into something that's recession resistant, we can't say recession proof, but recession resistant, right? And uncorrelated, you're going multi-level deep to make sure that you have as many barriers of protection as you possibly can in these specific investments. I think that speaks volumes, excuse me, to how this can play a role, how these types of investments can play a role as that diversification tool, because you're checking off multiple boxes, not just asset class.
Right. Yep, exactly. And why do people like the medical? And you were pointing at it early in legal industries. Well, here's the Federal Reserve data plotted by Brian, on my team here. He called my assistant, and I'll
Good
never
old
let him.
Brian. I'm sorry, Brian. And I saw him
Yeah.
on your team picture earlier. I was like, okay, now I've been communicating with him. So yeah.
So you can go to the Federal Reserve site and you can create this yourself, or we can give you the URL. But this is the reality. You know, for that 50% in alts and that 25% that's not in real estate, what are people looking for? They're looking for up and to the right. And as my 3-year-old would say, not squiggly, daddy. Right?
Cannot be helping it if I was saying things a little squiggly.
And so
It's the
if you look
technical
at
term, yeah.
just a technical term, yeah. So all the traditional investments here, if you're following my laser pointer, going for a ride, gold, USD, real estate, oil and gas, stocks, all going for massive swings over time. And then you see healthcare and legal services up and to the right.
Nice.
Now, within those industries, we're really focused on 2 areas. And of course, there's lots of ways to skin a cat. And as you spearfish industries with fundamentals that have the right fundamentals, you've got to figure out how to solve a need within those industries that has also resilience from AI disruption. And our specific focus is on funding attorneys that are going through litigation. Why is that? Because the outcomes of cases and awards or settlements are generally non-correlated to broader markets. There's one thing that we're famous for here in the United States, and that's going through the due process. Cases are settled by the evidence and the liability, the causality of the merits of each independent case, not broader markets, right? And same thing with the medical industry. And market instability does not generally influence the need or costs of medical care. And so by financing medical practices specifically geared around injuries and not elective type of offerings that are, fad driven or resilient, or that are more affected by disposable income, those kinds of things.
You're not financing BBLs in Miami, is what you're saying.
Yeah, I get a lot of people coming across my desk. I always, because we have a mastery series, I'm exposed to literally hundreds of alts all the time.
Yeah.
We have to choose which ones we put on, but a lot of these I'm just like, this is going to tank as soon as. So, so basically this is really it. And it's funny because this same Federal Reserve data I was plotting just with markets, went back when I was thinking about getting back into real estate after I recovered from 2009 and 10. I was plotting all the markets in the country, and Houston's single family, 3-bedroom, 2-bath, really leveled off during 2009 and 10 for a few quarters and started going back up. And looking at this graph, you saw a 14-year, 12-year recovery of values in other markets like Phoenix and Tucson and Orlando. So it is important to look at data like this from a macro sense and zoom out. Yeah. How have these fared over time? And then to overlay that with the current resilience of your specific investment. So, but I've been poring over graphs like this for like 15, 20 years. So not to date myself. But here's some examples. If people are still out there like, well, what the heck is he talking about? I don't know what he means, like non-correlated. But here's some examples. I call this the ruse of REITs, right? Because the financial planners are constantly telling me, I've got a whole article in Forbes. You can take this picture, that 2D barcode and go read about it. But financial planners promote diversification through REITs. And it just drives me
The
crazy.
entire industry, we don't laugh about it, but this is a definite conversation talking point because let's diversify into REITs. But yeah, I'll let you go further.
Well, they're mistakenly they're mistakenly, classified as real estate by these individuals. And you can see it, you can read more on the articles, but just in general, not only do they completely lack the depreciable ability and the direct hedge against inflation, which I've also written articles in Forbes about, and the security of a hard asset, because you're just buying a piece of paper that a company is printing essentially.
Right.
But they behave almost exactly like stocks. I mean, just look at the data itself and you can see, the real estate here is the green. That's, that's the more stability. And then you can see the S&P 500 and the REIT correlate almost precisely over time, right?
Yeah.
And so you cannot say that something that's almost directly correlated over 80% of the time is a diversification play. And I think that's where people go wrong. You have to go direct to real property. And when you're thinking about building stability, you have to invest into something that has different underlying fundamentals that are driven by the sentiment driven stock market. And so by doing an allocation in REITs, you're not getting there. And so there's a lot of things though out there. My entire mastery series, I think we have like 60 or so of these things now. There's a lot of things you can do, oil and gas, gold, technology, metals. I don't even know what some of these are. Forex or
ATM machines.
There's a Broadway musical. I know somebody doing that. Self-storage, single family. Here's another one that trips people up. Gold. I'm actually a metals guy. I actually do hold metals and as an allocation and as a cash equivalent allocation. And I store my cash inside of a what, Erica?
Oh, he stores it inside of an infinite banking policy.
Yes, I
He has his
do
own
for
banker.
asset protection, right? And
Yep.
so my cash and cash equivalent is inside. Most part of it is inside my infinite banking for many of the reasons we've stated. But what about your cash equivalent into metals, right? Something that hedges against the value of the dollar,
Right.
and that hedges against the stock market tends to be inversely correlated and counter-cyclical, right? So it's not directly correlated, but counter-cyclical to stocks and the US dollar. And it's a store of value. Happens to be really high right now. Happens to be that I did really great investing in it several years back. But it's more about allocations and not about day trading. And that's what's important here. And so if you look at, here's the very clear inverse proportionality of gold versus the S&P over time, where, when the S&P is low, gold's high, and then they go inverted and they go inverted and they go inverted again, right? So inverse correlation. Similarly to the US dollar, store of wealth. See the US dollar blue, gold orange, and they go inverted, they go inverted, they go inverted. So this tends to be a way to hedge your cash equivalents, which if you looked at the graph closely, you might see 7, 8, 9% cash equivalent, right? One way to do that is in other more stable currencies, which there turn out to be world banks out there, like the Swiss franc and the Singaporean dollar, which provide other accessibility to other markets, not directly correlated to the dollar, and allocations into gold, right? Which or cash, which can be held in an asset protected infinity banking account with insurance over what you would normally get in an FDI. I'm just kidding.
Shameless plug there. He's got it, y'all. He's on it.
And when we talk about asset protection, which it could be a whole other thing, I did, just for clarity, I did use a trust to put it into, although I'm in Hawaii and not only my initial amount, but the death benefit are protected here. That's not the case in every state.
Yeah.
And so I did it in a trust so that it was, regardless of where we may move in the future. And that trust allows me to be able to put money without increasing my lifetime gift tax, right? So it's less likely that if I end up croaking and triggering the account, Not will we get the cash value back, but the benefit itself won't be so taxed.
It was very strategic. It was fun. It is fun.
It's fun. It's fun.
You
It's
did
a
a great
long
job.
process. You mean by fun, you mean a long process. Yeah.
No,
Yeah.
it's it's always fun to get into the customization and get into the nitty-gritty. So
So we'll go into one more non-correlated, which oil and gas. And just because I like to trip people up a little bit, because low correlation to stocks, oil and gas, a hedge against inflation and stock market volatility. Although you could lose your ass doing working interests, but you could have a little bit potentially more stable long-term cash flow mineral rights.
Yep.
But one of the things that's important to point out is it's not necessarily uncorrelated. In fact, gold and oil and gas are correlated 80% of the time. And people
Interesting.
don't realize that. Yeah. So it's really important to understand where your allocations are to build true security and balance in your portfolio. And so that's why I go through like this extended process here. So what are my favorite non-correlated investments? We actually have something for that, but we talked about this medical receivables financing. It's really funding medical care providers. And the problem we're solving is the gap, right? We have the gap where you go, so these practices have signed contracts with these insurance companies. So when you go to visit them, they're going to give you care. They're contracted to. It turns out that doesn't mean they get paid for the care. The insurance company may take 15, 30, 60 days, or in some cases, 180 days.
Wow.
If it's a workman's comp or an auto-related issue, it could take 2 years. And so you imagine being a healthy practice, doing well, providing care, doing everything right, but then also was sitting with $5 or $10 million, waiting on a 1-2 year plus, sometimes on the rare case 3 years to get these funds to you. What are you going to do? And so these otherwise healthy practices might say, look, I really would love to invest in growth. I'd love to buy a new piece of machinery, hire more staff, maybe buy the building I'm in, or add another building somewhere else in town. And so they strategically might come and say, hey, look, here's my pool of accounts receivables. What are those? Those are actual contracts, IOUs from insurance company. We can see what they are. They're Joe Schmo had this issue, and we can verify he's covered and what the service was. And yep, that's a valid asset. And the payor, the obligor, turns out to be the highest rated payers in our country. The Cross Blue Shield, the Medicaid, Medi-Cal, whatever. These are the payers that aren't going to go bankrupt in this country, right?
Yeah.
And so we'll say, okay, Mr. Medical Practice, we'll help, right? We can be a part of a source of relief for them in a short-term liquidity. And investors like it because it's asset-based, right?
Yeah.
It's payment obligations for healthcare services already rendered. Really strong payers, credit-worthy insurers and government agencies. It's not the medical practice that you're worried about.
And it's not the patients, like you're saying. You're not trying to go collect a bill from Joe Schmo down the street, like, hey, pay your $200 ER bill.
Yeah. And we get security. Not only do we get security because we can then lockbox, we can go to the insurance company and say, hey, we are now have a right to this, pay us, and we'll lockbox those funds. And then, but we can also put a lien up against the assets of a medical practice. Like, how cool is that, right? And the principles of the medical practice as well. And so we have a really strong payer and a backup plan.
Nice.
And so the margin of safety is incredible because we can look at the practice's ability to collect over their past, just like in a real estate deal where you might look, okay, let me see your P&L for a month and let's see how much work you've done and your ability to collect on rents. In this case, it's ability to collect on the bills that you put, how much service you've done, how much you billed the insurance company, and what they paid you. Like, how much is your estimated value of your collections based on what you've actually collected in the past. So we can look at that. We can look at the health of the practice. You can make a quantifiable assessment of your risk here because it's an existing asset that has a historic collections rate with a really strong payer. Investors really like that. And then you can choose receivables that have different durations. Like
Oh,
there's historic data
interesting.
that shows like, hey, this is actually a 15 or a 30-day receivable. This one's a 6 month or a 1 year. And so, or here's some auto policy stuff that actually takes 2 to 3 years.
Yeah.
And so you can choose that too. And so investors really like these.
That's fantastic that you're not just grouping it all together, that you're able to get down into the different,
Right.
like you said, the different schedules of pay. Holy cow.
So we won't, and just to be clear, I'm not one to go buy a one-off receivable and hope. We'll take a
Yeah.
medical practice and we'll say, okay, show me all your receivables and let's figure out your collectability of all these. And then let's say, okay, here's the total value that we think you're actually going to collect, our version, based on your historical collections rate and the timing of that. Okay, we're going to collateralize all of that, your assets, you personally, and then we're going to go lockbox all the payments for all of them from the insurance company. And then, but we're going to provide you this small amount of financing to your whole receivables portfolio.
Love that.
So we're going to first position essentially a lien, UCC one against all of their receivable assets and the assets of the practice itself. So like our return is paid off. It's so below the collateral value that we're paid off, and then we provide the rest to the medical practice, right? So it provides for what we consider to be a very low financed amount to the overall collateral value.
Very
Where
nice.
in real estate, people are investing 70, 80, 90% of the
Yeah.
value of the property, or rehab or construction loans, which are inherently 150, 200, or 300% because there's oftentimes no value starting out, right?
Right.
So this is an asset-backed lending where you have that equity on day one, and it's a type of financing arrangement that you never have to be anywhere near the value of the collateral, right?
Wow.
So people really like it. Investors really like it. I really like it for that, right?
Yeah, I can see why.
Yep. And on top of the stability of the market, and you can clip some pretty strong returns. I think you said we could show the returns themselves. And
Oh,
so,
yeah.
yeah, in this market, you got to think, well, man, in the medical industry, it's lower risk, so you're not going to clip like you're not going to 4 and 5 and 6x, your money. Well, you
Right.
can in any industry, right? You can be like I was in 2009 and 10, hoping to double and triple my money every year in development, pre-development, right? But
Yeah.
then lose it all. Or you can be a wildcat oil and gas driller and hoping to 100x returns and lose it all. Or you can be an angel seed a venture capitalist and then know that out of your 100 investments, a third are going to go to zero, a third might break even, and a third will hopefully make up for all the other losses. That's actually how they think. I don't ride those waves. I don't do the big gambles. I want to work with well collateralized and secured investments where I can clip a reasonable return that has resilience from broader market volatility and low correlation to the rest of my portfolio. And
Love
so
it.
that's why you see really cool returns here, which, mid-teens is awesome for the industry itself, right? So, and then it's compounded. Like we compound our returns. Einstein said compounding interest is the 1/3 of the world. Who understands it earns it, who doesn't pays it. And so you can clip a 2x return in 5 years through compounding through quarterly reinvestments. So I mean, it's
Just
pretty amazing.
reinvesting the returns that you're getting so they can continually ride that compound interest curve upward.
Yeah.
Yeah.
hmm
I
Yeah.
love it.
So that's medical. We can touch on legal. I mean, I don't know what the time check is here.
Yeah, we can do another probably yeah, we can do another 5 minutes. Yeah.
Okay, let's
And go
touch on
through.
legal. Legal is very similar to medical. It's just in a different industry. You're solving needs in the legal industry. And in the legal industry, like in any industry, if you want to invest, you got to figure out what they need. And there isn't a lot of needs in the medical industry. It's not like the airline where there's tier 1, 2, 3, suppliers, and it's highly complex with a bill of material of 1 million parts, right? It's just there's a bunch of dudes working hourly, and they're just working hourly, and there's really not a lot there. It's not as complex as most industries. There is a contingent of attorneys out there that are saying, look, I may have an hourly practice, but you know what? I'm also going to do some things on contingency, meaning these people can't afford my help right now. but I believe in their case. I've got a lot of time and energy in their case. I'm going to go ahead and sign an agreement with them that I will get a percentage of the settlement value as opposed to having to pay per hour, right?
Yeah.
And so, and that helps. And because in this country, if you're wronged, you can get help. You can get justice. We through the court system, and that's just called litigation. It's not, but the problem is it's expensive.
Very.
And so to do that, but the settlements of these cases can be very substantial because turns out there's people actually harming. There's companies and organizations and institutions harming individuals, like sometimes one-off individuals and sometimes lots, like thousands of individuals. And so it was actually the first big notable case of legal funding where a third party like our firm stepped in and funded attorneys, just like we're funding the practices of medical practices or real estate operators. We're funding attorneys to one, either, if they found a case, go find more people that were similarly harmed, or for expenses to then get to the finish line. Was back in 1920 when American tobacco was, saying that cigarettes were healthy. And, litigation funders stepped in and said, look, we're going to support these people because it's clearly a lie. And so there was $billion settlement, but it took litigation funding in order to go up against the behemoth of American tobacco. And they were successful. And since then, some of the really, really cool cases, of our time, are like Camp Lejeune water contamination. Where
we've all heard of that one.
17 years, the government, the DOJ, knowingly fed poisonous water to our military, civilians, and their families. The aqueous firefighter foam, or the PFAS type stuff, talcum powder, sexual assault cases. We supported an attorney that was identifying individuals that were harmed through a sexual assault in the LA Juvenile Detention Prison Center, right?
Oh, no.
And they settled last April for $4 billion. And we had 19 individuals that we had, through our attorney, helped identify and funded. And so they're actually receiving settlements through that. And our investors are participating in the attorney's contingency fee portion of that. So for example, like we're actually doing some good in this fund. And I think there's 1,800 soldiers, civilians, and their families inside of our fund, where we've helped two different law firms identifying and finding harmed individuals which were present at Camp Lejeune during the time and have medical records showing symptoms proven by the toxicology department that it was caused by the chemicals in the water. That's a lot. And so we've helped attorneys that are helping 1,800 different individuals at Camp Lejeune. So those are some of the examples. My partner there, Dave Gooseman, he's been involved in litigation for like 15 years now. He's managed $500 million funds. He's initiated efforts to collect over $25 billion or $24 billion, mostly through institutions and private equity. We met kind of dueling on apartment investments. And when I learned he was in alts, we resonated. And he was one of the dudes that I was trading baseball cards with early on. Yeah. Like, because he's done all kinds of alts, but for hedge funds, sovereign funds, private equity groups, but all $20 million buy-ins. And so he finally hung up his hat in New York, left private equity, and came back to California, where I was at the time, and said, hey, I wouldn't take your money before, but how about we set up a fund now? And now we've set up a fund. We're having a lot of success. And we're essentially just allowing attorneys to work in a contingency and provide access to justice by collateralizing their assets, which is their contingency fee agreements. And we're doing it in a hyper-diversified way. It's either very late-stage cases where there's settlements already proposed or in discussions and they're near the finish line, or it's individual cases that are what we call established law. That are kind of rinse and repeat, the fairly predictable outcomes. And so, like I said, there's ways to be super risky with every industry, including legal and medical, or you can invest for more reasonable returns really late in the game.
Yeah.
Right. And it happens to be that these high value cases, if an attorney has like 100 or 200 individuals, they can that we can invest in them, and they can take their existing contingency fee agreements, which we can put a lien against, and a financing agreement like we do in every other industry, and we can value those on the value of those, and then provide a 10 or 20% finance amount to those. They'll sometimes use those funds to then go find another 100 or 200 or 300 people that were harmed, so that one, they look more intimidating to the defendant, and two, that's just a bigger piece of pie. It's more
Yeah, that's a
people
bigger
getting
settlement. Yeah.
settlements. It's the attorney getting more, and us enabling that access to justice for those that were found through our funds and participating in, what we just like in the medical, we cross collateralize the attorney's docket of cases, and we have thousands of individual lawsuits, and it gives us an institutional quality litigation finance investment with non-correlated growth potential. And
That's super cool.
yeah, so
To
I
be
mean,
able to
here's
bridge the gap, right? There's so many people on the, like you said, on the legal side that need that help but can't afford it. And the attorneys, here's the thing, they got to pay bills too, right? So you guys are bridging the gap on the legal side. And then on the medical side, same thing. Doctors need to be able to continue their practices while waiting on insurance to pay out. So just that is impactful. That's incredible. So yeah, go ahead. I'm sorry. I'm blown away by that.
yeah, you got it. It clicked all of a sudden. And the reality is that lending into real estate, financing medical practices, financing attorneys are all just private equity asset-backed lending strategies. And they all have collateral. They all have obligor payments that are strong. They all have liens and secured interest. And they all have large diversification plays, right?
Exactly.
And they can either be done high risk and high return, or lower moderate risk with very reasonable returns. And that's what we believe. And so I'm really big into this private credit space. Why? Because I've lost it all as the owner before, right?
Yeah,
I've
you've been there, done that, got the t-shirt, right? Like you have the scars, and so you're able to speak to that.
I prefer being at 10, 20, 30% to collateral value, or in legal, or in our debt fund, we're at 65% max in our documents to loan to value, and then medical, depending upon the type. But in the long-term receivables, it's right around 30, 40, or 50% finance amount to the class. I mean, that leaves so much volatility, right?
Yes.
That we're sitting pretty, and so much cross collateralization that losses happen at the end, usually after we're out of the deal, right? Because if there's any that don't come through, that comes out of the top, the owner, right? I don't want to be there for the foundational diversification strategy within my portfolio. So I mean,
Right.
this shows like a settlement grid for Camp Lejeune, where it shows like, okay, how long were you there? 30 days to over 5 years. Okay, that's what duration column you're in. Okay, what your medical records? What do they say? What kind of disease did you have? Was it tier 1 or tier 2?
Like what
And
tier
then
you fall into.
here's your settlement grid. You can make 100. You're entitled to 100 or 450,000, and you can settle with that today.
Wow. Just
So that's an
like that.
Yeah, Roundup, I think people have heard about Monsanto falsifying, but I mean, we have, like, talk about the low investment amounts to collateral value. It's like a 6% on the Roundup and Camp Lejeune. The sexual assault case was like 20% estimated investment amount to collateral value. Just provided some example of the litigating law firms that were referring our attorneys that we're financing are referring these to. They collect billions of dollars and past settlements. And I always put this up because sometimes people are turned off by litigation. But
Yeah.
some people also turned off by real estate, because there are a bunch of money grubbing slumlords out there.
Oh, absolutely.
And aren't they? I mean, oil and gas too, right? And then
Yeah.
aren't there a bunch of crooks in that are people are losing, angel seed venture capitalists are
Yeah.
losing money in?
Yeah. And I
Every
mean, in
industry
any
has their
industry,
bottom
right? In
feeders.
finance, in doctor, in any industry, there's bad apples, right?
Malpractice, right? Every
Teachers,
industry,
nurses, like they're everywhere, right? You can't get rid of scumbags.
Unfortunately, they're everywhere.
every industry has their kind of bottom feeders, and so
Yes,
we
there you
put
go.
this up. We put this up saying like, look at the cases we're doing, right? These aren't frivolous lawsuits. These are
Yeah.
providing not $50 or $80. These are providing hundreds of thousands of dollars to the harmed, and increasing access to justice, enabling attorneys to engage with harmed individuals, leveling the playing field between the big Goliaths and the Davids, targeting large corporate misconduct or institutional misconduct and generating fair compensation, and delivering substantial returns. That is actually pretty cool. And I think that just like in our real estate deals where we say we provide a cleaner, safer, and improved living experience for our residents, we're providing access to justice for harmed individuals that otherwise couldn't afford it, that truly deserve it.
Yeah.
And it has a meaningful outcome for them and their families, which is oftentimes the next of kin in a lot of situations, right? So
I love that.
we have like, I think right now we're, projecting around a 2.5x equity multiple, 20 to 35% IRR across I think we have over 5,000 individual lawsuits and over 45 million in value, our estimated value of the settlements. I mean, that's incredible, right? Those are big numbers. Hyper diversification, and keep in mind, unlike a real estate portfolio where you have a bunch of assets in there, but all of them are driven by cap rates. All of them are driven by interest rates. You can have the biggest portfolio in the world of real estate assets, and they're all going to rise and fall on one tide.
Yep.
What's fascinating about legal is each of these cases are going to be, the words and judgments and settlements are going to be based off the merits of each individual case.
Yes, they're not correlated to any industry or even to each other, right?
Yes,
they're completely independent.
If you're in a diversified portfolio like ours, where we're approaching a lot of different kinds of law, you're actually building internal diversification, not only through cross-collateralizing multiple cases at each attorney, but having within the fund so much exposure to so many different cases. And within those types of cases, each individual lawsuit, thousands of lawsuits, each of those are settled on their own merits. So this is why it's attractive to hedge funds, sovereign funds, right? These private equity guys. That's why they're dropping $20 million, $50 million. And people like Dave Guzman, before we partnered up, and Dave Guzman was like, "You're not worth my time." Because it truly gives resilient returns. It provides pillars, just like medical practices, right, into your strategy, which won't rise and fall, won't be stabilized by any tide in any particular industry.
I love it. Yeah, I think those are incredibly fascinating. I haven't heard of anything like this. And like you said, this is a truly alternative way to diversify against the ups and downs of every other industry, economic cycles, and everything in between. So this is great.
And we always like to say, like, there's a lot of people out there that are experts in their industry. Maybe they're a business owner, maybe they do infinity banking, Erica, or maybe they do real estate. But then if you've been just pushing, like I did for many years, one asset class to your investors, are you really serving them? And so we offer feeder funds, capital allocators, sponsors the opportunity to engage in a JV or a sidecar fund with us to participate in our deals, so that they can offer something of complete, like, investment in a box for them. They can offer something to their investors and themselves, completely
huge for operators
different,
too.
non-correlated alternatives. And so this is, I think, one of the best things you can do, because the reason why I left my first company in apartments and I went to Passive Investing Mastery is because I didn't want to be part of the problem that just kept pushing one over allocation in real estate. I wanted to be able to provide authenticity into how I think portfolios should be done and allocated, and to be part of the solution to give rounded, stable pillars into portfolios. And so you can do that too, and you can do that for yourself and others by partnering with us, and we'll set up a fund in a box or a JV in a box with a full marketing package and all kinds of collateral to market, help, and support. And we've had a lot of success with that.
And that these, the sponsors in the real estate space have clients that are coming to them, or they have investors coming to them looking for and asking for that advice. So this is a huge opportunity for operators to look at, one, like you said, serving your investors, serving your people, to be able to give them this opportunity, and put yourself in the position of credibility, saying, "Hey, I understand I can't be all things to all people, so let's look at some other options here and create those strategic partnerships."
And I know, because I'd done it. I was the real estate, doing apartment deals, and when people were like, "Oh, I'm tapped out," "Oh, I got," and then all of a sudden we launched a commercial debt fund, and then they're like, oh, hey, here's 100 grand, here's quarter million, because now you're in a private credit cash flow position, right? Then you launch a legal fund. Oh, wait a minute, I have something for that because I'll take something out of the stock market and put it there because I actually don't know where else to put it. I don't like the stock market, right?
Right.
So what happens is you become a better solution, and it doesn't cannibalize what you're doing. Actually, it complements, because now you can tap into other
There you
buckets that the investors have that they otherwise wouldn't tell you about or wouldn't imagine that you would be a fit for. So
It's
that's
that abundance mindset, right? Like we don't need to feel like,
right.
oh, I need to keep all the funds. And I'll tell you, I have a lot of clients and a lot of people that are sponsors that are trying to raise money for real estate right now. And I know it's hard. I know it's hard to raise money for real estate, but maybe one of the reasons that it is hard is because people are starting to realize real estate isn't always going to cash flow. It isn't the silver bullet. Again, real estate is a great investment, but I'm in probably 5 different LP real estate deals and none of them are cash flowing right now. So I think people are starting to realize that's not the end all be all to their portfolio and they're wanting more options. So if you're a syndicator or an operator that's having a hard time raising money, maybe it's because you need to open up the avenues for your investors to have some different opportunities. And this could be a new way for them to diversify.
100% agree. The hardest thing is building that relationship and
Yeah.
trust, and the investment and time to build that relationship and trust with an investor.
Hmm.
If you can be more than just a widget to them, if you
Yeah,
can be a toolbox to them, you're going to serve them and you at the same time, and the return on your time and relationships will be much higher. Um,
absolutely.
so, I mean, we have investor portals, but I mean, there aren't any questions here, but if anybody's interested, I give away a free copy of this book. It's called Lessons from Thought Leaders. I tell my whole story, the ups and downs. I participated in this book with a bunch of really other cool people.
Love
There's like a
that.
Navy SEAL in there. Brian Tracy wrote,
Oh,
Kevin Eastman,
wow.
Tom Ziegler, Dennis Waitley, I mean, it's just really fascinating book. Phil Collin was the lead guitarist of Def Leppard. There's an actual rock star in this. So I
That's so
love doing it.
cool.
Yeah.
I didn't
And
know that. Well, I'm gonna,
and he's right here, and I'm this guy, the engineering nerd next to the Navy SEAL. But I mean,
you're the
I give that
serious one.
away. Scan the barcode, go to that URL, and I'd be delighted to. And I'd love to meet with you wherever you're at. I always have time on my calendar. What are Patrick's favorite non-correlated investments? This is the most common question I get. If you scan that barcode, that'll take you to a site that's a PDF. All I do is list them on the first page or the second page. And then it's a choose your own journey. If you want to read more, I write more about them later
Oh,
on.
super cool. So you can pick what you want to
And
dive deeper into.
yeah. And then we have a wealth accelerator, people that are interested in kind of getting a little bit more closer conversation, but you can always just set up a meeting with me, and that's it.
I
So,
love it. And we're gonna put, so if you're on YouTube and you're watching this, pause it, scan the code. I'm also in our emails and communications on the social media, all of the things. We're going to put links to these different sources so that people can continue to go and download the book, get into the wealth accelerator, and you guys, y'all have a great opportunity here to connect with somebody who's been through it, been through the fire, gotten the scars, and has come out on the other side saying, all right, I learned my lesson. How can I pivot? So learning from somebody else's hard lessons is way better than having to experience it yourself. I'm sure Patrick can speak to that. I can speak to that. Thank you so much. This has been very informative. I know we've talked about it, at a high level, but to be able to get into the details, just wow, this has been great. I appreciate you sharing all of this.
yeah, thanks for having me, Erica. Always a delight chatting with you, and I look forward to seeing this session and having you on again sometime soon on our
Oh,
platform.
yeah. And we'll wrap up with one question. So something I like to kind of get, because again, the whole premise of this channel is talking about real money, real people, and the experiences of that. So Patrick, obviously you've been around for a long time. You've had a lot of good experiences and bad experiences, right? So you've been able to really gather a lot of wisdom. What would be one piece of advice that you would give to investors who are trying to build resilient wealth in today's market?
Well, I guess, shoot, there's two pieces. I apologize. But one is build your tribe. Because what
Mm,
I did before is I didn't try to do it all on my own. when I was doing first, and I lost everything in 2009 and 10. And then I tried to do it all on my own in single family, and I was successful, but I lost my life, my time, my time, my freedom, my family, friends, hobbies. So that's why I had to stop. And then I learned to partner and I learned to scale, but I had to find a tribe, people that had been down the road before. That's why I offer to talk to people wherever you're at in your journey. That's why I offer to give the book away. Find your tribe, go to some meetups or attend our mastery series. Every 2 weeks, you'll learn about completely different alternative things. Set up a call, go to meetups, find people that are doing and being these things different, and you'll learn about how not to make the same mistakes. And then I like to tell people you got to learn to partner, because when I was trying to do it all on my own, I thought, I'm a brilliant engineer. Well, that may have been true, right?
It's Superman syndrome. I can do everything.
I can't compete. And I get the same conversations with people that have, the attorneys, the doctors, the CXOs out there. Man, you have something you're doing to produce good income, but to truly have security in your financial success, you've got to be in 7 to 10 completely other things.
Yes.
Nobody can live 7 to 10 lifetimes to become the master in 7 to 10 completely other things. Just high tech is not enough. Just high tech in real estate, not enough. Just high tech real estate in the stock market, not enough. You've got to be in 7 to 10 completely different, non-correlated, fundamentally different. Elon Musk doesn't have a quality of life you want, and he's not even in that many right now. So the only way to true financial security is learn to partner, learn to find these alternative investment strategies and to begin to allocate. And that requires the ability to become somewhat passive so that you can balance the contributions of the causes you care about most in life. And that's part of our mission, right? And family, friends, and hobbies, and whatever other causes you care about. So sorry for the 2 items, Erica.
Those were great. No, those are great pieces of advice. I think that speaks to a lot of people in what they're looking to accomplish. So I think that was great. So Patrick, thank you so much. This sharing your wisdom, your knowledge, your background, all your insight into this incredibly unique investment criteria. So you guys, we've got the email and the phone number and all of those things. And we've got the passiveinvestingmastery.com/infinity. Again, go to these sites, take advantage of these free resources you're getting from an Amazon bestseller and Forbes speaker, right? Like this person who obviously has so much to share with you. Take advantage of this. I'm going to also be sending we'll have the links in the description of YouTube. We'll have it in the email and the social media, but you guys definitely take advantage of what Patrick's offering. Again, thank you so much for coming on and sharing this, Patrick. It's been great.
Thanks for having me, Erica.
Thanks. All right, y'all. So if you haven't already, again, don't forget to subscribe. We are doing one of these every single month where we sit down with, again, real people making real money so you can too, and you have the ability to learn from other people's experiences. Until next time, keep it real. At Infinity Investment Strategies, we teach investors and business owners how to become the bank. In using the infinite banking strategy, you can lower your taxes, increase the control you have over your own money, lower your risk against multiple wealth eroding factors by adding additional layers of asset protection, and increase your leverage with guaranteed growth and the opportunity for dual rates of return. With authorized infinite banking practitioners with experience in business and investments, we are here to help enhance your portfolio.